Hiring slowed down. We're going to talk about the economy for a moment. Hiring slowed down in December, according to new numbers out today. Employers added 199,000 jobs last month. That's way below the more than 400,000 economists had predicted, although the unemployment rate did drop to 3.9%. It's a confusing picture. To help us sort out what's going on in the jobs market, we're joined by ABC's Elizabeth Schulte. Elizabeth, what's behind the hiring slowdown, and were there bright spots in this report? What's going on?
Well, Terry, this was the second straight month where payroll growth disappointed. Those 200,000 jobs, half of what economists had expected, and well below the average of more than 500,000 that we had been seeing every month of 2021. But as you mentioned, the good news came in the unemployment rate, which ticked down to 3.9%. So that's now below 4% for the first time since the pandemic started. And you can see there, it's now at the level close to where it was from before the pandemic. So what this tells us is that the slowdown in hiring is largely because businesses are having a hard time finding enough workers. And this has been something we've talked about, this labor shortage. But really what we're seeing there are signs that there are now 2 available workers for every 3 available jobs. So workers really have their pick. They are quitting in record numbers. 4.5 million workers quit in the month of November alone. And so really this tight labor market is very evident in this jobs data, even though it is a little bit of a mixed bag, Terry.
Elizabeth, if I can pick up on that last point, the Great Resignation, they call it. So many people quitting. What's going on? Well, why are we seeing it?
I think it's a really important point a lot of economists are making now. This Great Resignation comes because we are seeing record quit rates month after month. But really what it is a little bit more of a great renegotiation or a great reshuffle. In other words, a lot of the workers who are quitting, they aren't just quitting to say, I'm going to stay home and stop working altogether. They are quitting their jobs to take on new, higher paying jobs. And this is especially proving to be the case in industries that are typically seen as low wage. So think of retail, hospitality, food services. We are seeing record quit rates in those sectors as those workers look for opportunities where they can be making more money. They have leverage right now to do that, and they are taking this opportunity to make more money. And that's also why we are seeing wages go up. This latest jobs report showed wages continued to spike again last month. They continued to rise at a very fast pace for all of last year. And this is a sign that businesses are going to be dealing with higher costs as they try to lure in and attract more workers, Terry.
Well, that's good news for workers, that inside this jobs report, as you break it down, you can see that the people who are in the job market making more money, their labor is more valuable, and they can be a little bit more choosy. But what I want to ask you, the stunning jobs numbers, what is stunning about them is they were compiled before the Omicron variant caused a spike in COVID cases and business closures, and everybody's back inside in a lot of places. How is the current COVID surge going to impact hiring in the next month's job numbers?
Absolutely. So we've seen all these business closures just in recent weeks because a lot of workers are calling out sick. They either have COVID or they have to stay home because they're isolating. This is hitting industries from Broadway to hospitals to airlines to schools. And really, it is likely that that's going to show up at least in part in next month's jobs report when this will be included in the data that's collected. So some economists are worried that hiring could slow down in the next few months because of this variant, that workers might be a little bit more hesitant to return back to the workforce because of these ongoing health concerns. One really kind of sticking point has been the labor force participation rate. And basically that means a lot of workers who've been on the sidelines throughout the pandemic, they are still not coming back. And this has been a puzzle all throughout the past couple years. But really, as the health concerns have lingered, so has the labor force participation rate stayed high. And one thing that we've been looking at really closely, Terry, is the child care issues. A lot of workers are unable to come back to work because they do not have child care support. Daycares are closing, schools are closing. It's hard to go back to that full-time job when you have so much uncertainty about your children's schedules, and that's something we're still seeing playing out with this latest surge too.
Still, and it is worth remembering, I lived overseas. The United States, really the only developed country in the world that does not provide support for child care. President Biden's touting what you were describing earlier, the surge in wage growth over the past year. But I guess there might be inflationary concerns around that. Do you think the Fed is going to look at wage growth and get worried, or is this something it can manage?
Right. Well, you mentioned these wages growing up. That is a good sign for workers. They have leverage that they haven't had, frankly, in many years. But it also does mean higher costs for businesses at a time when we are seeing consumer prices and inflation at a roughly 40-year high. So the question is, are these wage hikes going to be longer term? And this is really the big question mark for the economy this year. Are employees going to start demanding higher wages to keep up with inflation? And that could kind of turn itself into a bit of a spiral where inflation lasts for longer. And that's something that the Federal Reserve is worried about. They have already signaled that they're going to raise interest rates sooner than they had planned because of higher prices and because of strength in the jobs market overall. So if interest rates go up, that means borrowing gets more expensive for businesses and consumers. Basically, it's a way to try to slow down demand, which has been so strong throughout this pandemic, partially because of all the relief that the Federal Reserve and from Congress here in Washington have provided. Some of that now looking like it's going to get scaled back because these prices have stayed high for longer than many had expected, Terry.
It is a complex picture, and Elizabeth, we thank you for helping sort it out for us. Thanks very much, Elizabeth Schultz.
Thanks so much.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.